A spike into a supply zone looks like a rejection. This chart reads it more precisely. A reach for the liquidity resting above the highs. A long recovery builds an obvious shelf of highs. Then one climactic volume spike runs the orders above them, tags a bearish order block at the same level, and fails. The spike that ran the liquidity was the top. The chart opens mid-downtrend at the top left, lower, highs and lower, lows driving price down. Sellers are in control, the direction unambiguous. This is the move that establishes the bearish context. And at its first lower high, it leaves the supply behind that the rest of the chart will return to. The reference high that gets swept at the very end is born right here at the start. Price takes out the prior swing low, and the break of structure is marked on the chart. The market commits to a lower low, the downtrend's grammar intact. This break defines the order block's credibility. A high that precedes a confirmed structure break is the origin of the move that broke the market down, which is what makes it a supply zone worth watching later. The supply zone, the pink band near the top, sits at the lower high that began the breakdown. It hangs above everything that follows, untouched, far above the price action, waiting. Be clear about its role here. It is not the thesis, it is the destination. The zone matters because it is where the liquidity above the recovery's highs will happen to sit. The tag and the sweep are the same event. From the order block, price marks down hard, then bottoms and bases at the lows in the middle of the chart. The selling exhausts, the range compresses, and the conditions for a recovery assemble. This base is the launch pad for the long climb back, and the climb is what builds the shelf of highs whose liquidity eventually gets run. Without it, there is no pool of orders for the spike to reach for. Out of the base, price recovers in a long, choppy grind, higher, highs and higher, lows climbing back toward the order block. As it climbs, it leaves a series of swing highs behind it. Each one is a level where breakout orders sit and where short sellers place protective stops. A recovery that grinds higher in steps leaves an obvious shelf, and above the most recent high sits a pool of resting orders. By the time the recovery matures, there is a clear pool of resting liquidity above its highs. This is buy-side liquidity, the protective stops of shorts and the breakout orders sitting above a new high, orders that fill if price trades up through the recent swing highs. Is the fuel a sharp move would consume? The more obvious the shelf, the more likely a move eventually reaches up to run it. Price launches into a sharp, near-vertical spike on the largest volume bar of the entire chart, the tall column in the volume panel. This is the move that runs the liquidity. As price trades up through the recovery's highs, the resting orders fill all at once, and that is exactly what propels the spike. The volume is climactic because it is the sound of that liquidity being consumed. It is not a calm drift to a level, but a reach to collect the orders above an obvious high. The spike carries price all the way up to tag the bearish order block, and here the two ideas meet. The liquidity above the highs and the supply of the order block sit at the same place. So the move that swept the highs also delivered price into supply. The new high at the zone is the peak of the entire recovery. Price ran the liquidity and tagged the supply in one spike. Price is rejected immediately. No acceptance above the swept highs, no close that holds inside the order block. just a sharp reversal back down. The long upper wick tells the story. Price reached up, ran the liquidity, touched supply, and was thrown straight back. This is what a failed sweep looks like, a violent reach that, having consumed the orders, has nothing left to carry it. The absence of acceptance is the confirmation. After the rejection, price rolls back over into a renewed downtrend, lower, highs and lower, lows stepping down through the right of the chart. The recovery is over. In hindsight, the climactic spike was not a breakout attempt, but the final act of the advance, the move that ran the last of the liquidity before the turn. The shelf that looked like a base was the liquidity the spike came to collect. Three things to carry from this chart. First, a sweep is a reach for liquidity, not just a touch of a level. Price runs the resting orders above an obvious high and reverses, because collecting them was the point. Second, climactic volume on the spike is that liquidity being consumed. Once the resting orders are filled, the fuel is gone. And third, when a liquidity pool and a supply zone sit at the same price, the location does double duty, and the failure there is sharper than either alone. If reading charts this way is useful to you, subscribe to SMC Chart Sense for a new chart read every week. That's the best way to keep these in your feed.